Okay, this is Brian Stoll for Timing Strategies, Tuesday, February 19th. And what can you say except more of the same? I'm going to kind of do more commentary in depth when we have more significance to actually go over. Right now we just got a bunch of congestion, so I'm going to probably cut back from doing these on a day-to-day basis and try to be a little more active, a little more detail on inflection points or areas that I see of opportunity, of potential. Okay, that said, real quick again, if the YouTube cooperates, this video should work. If not, well, sorry, I can't help that. Let's get started. Spiders today using the S&P right back up into that range. My estimation, as I said, I'm looking for a bust of this low right below that 130, 175, 132 level. Looking for a trade somewhere down here in the 128 level, right? Again, we're still looking for that. Tested this range somewhere down here, maybe even a bust of this low right down here of January 22nd. If that happens, certainly I'll give a little more detail. But if we trade below the low of that, let's say we come down here, and again, forget the little numbers that I got on there because that's a default. And then we trade back up. I'll be looking to get long on a close back above that 126 level. In the meantime, still short-term targets, or short-term, what do you say, the next 3 days to 3 weeks, whenever it happens, if it happens. We're looking for a bust of these lows, the 132, and a trade and a flush down in here. And at that point, we'll see what we're going to do next. I do make that caveat statement is that if we get a close above the 137 level, which is this one right here, the highs of 2 days ago, 4 days ago, and then we hold up there on a daily basis, on a closing basis, above that level, for 1 or 2 days, we may consider reversing, at least going flat. Maybe we might get long a little bit, but this is the range that we're establishing right now. So between the highs of January the 31st, February to here, there's enough movement in here. There's enough range. That's a 5% move, a range that gives us, really basic bread and butter allocations, a little more than a 5% move to work with. We can work with 5% in a range. We can work a lot nicer with a 7.5 to 10% range. But long story short, I think we're going to wind up trading sideways, and this is just a think. I think we're going to wind up trading sideways in this range for quite some time until we get resolution. And what's going to do that? When is it going to happen? Don't even ask. I don't know. And let's go to some other areas real quick. XLF. I wanted to bring this to attention here because, if you take a look at that, we got another daily close right at that 26.85 level, and that is such a key level. It's just snagging day up, day down, day up, day down, open, close, switch above and below that level. I'm of the break to the downside resolution mentality, but again, because everybody's watching it, everybody sees it, something's up with that level, and let me just show you why. Go all the way back to, well, we're going to have to go back even further. Back to the 2004 lows, okay? The levels of 4 years ago in the XLF, it's just getting switched back and forth above those levels. Same thing with the BKX in the banking sector. Remember, an object in motion tends to stay in motion. We're below the short-term averages. We're below the long-term averages. I believe we're going to see another test of that low somewhere around the 24.65 level, maybe even a stab or wash a blow there as well of the January 26 level. We'll see, but, again, anything can happen. And let's go to another one here. GDX, all the gold bugs out there, including myself, closet gold bug. The GDX is starting to take off again. This is a very good potential long setup, but again, it happened, over a holiday with that Northern Rock European bailout situation. So I'd give it 1 day before I take off or I get too excited on the gold side. What I would want to point out is, and this is something for me, new, that I try to do as much as I can, as best I can. I always fall short, but it doesn't keep me from keep on trying. And I'm sure some of you already may have known this already or not, but the XME, which is a metals and mining stock, far stronger on a relative strength basis than just the plain GDX. Now, I'm not recommending this to anybody, but if you want to use a spread right now, and right now may not be the best time to put that spread on because we've got a XME, which is actually at an extreme, or probably a potential local maximum new all-time high. If we get a retest of that level, of the breakout level of 7150, or back down into the shorter term averages that we've got, then that might be a time to put a spread on. This might be a bull trap, we don't know, but it was heavy volume on whatever news you want to try to point the finger at. But for a safer trade or play, I'm actually considering doing a spread against the GDX because it's slowing down. It's slower than the XME, but it's in the same sector, and it just looks just like, you know, I've done some spread analysis and it works really good. Looks real good. Another point I want to bring up here is the QQQQs. Everybody loves the Qs. Well, guess what? Nobody loves the Qs today. Worst performer. You know, we're in a trend sell mode. This is just by all definitions, you know, a congestion level that we've got, and resolution for the most part really looks like it's going to work its way out to the downside. You know, if you want to use that, whatever. We're congesting right here at the lows in a tighter contraction range. Again, resolution to the downside is more likely than the upside, but anything can happen. How would we know when to change the thoughts or the opinions? You know, if we can get a close or an expansion on a price move by about 0.5 to 1% above that 44.45 level, you know, we might get the resolution to the upside short term. Longer term, we're in a bear market, and you know, you can look at the SMH to prove that. Used to be the big winner of the Qs, now it's Google and RIM and Apple. They're the next, you know, giants to fall. Point being, we're in a bear market, and it's just a matter of, you know, getting a position on at the right good location in the bear market, basically selling the rally. Where's the rally running out of gas to get short at for a longer term move? In the meantime, what we want to use is kind of a range bound methodology, because markets range 60-70% of the time and they trend maybe 40 to 30% of the time. So this range that we've got here on the Qs and on the spiders, for the most part, is likely to be maintained for a while. Like I said, could be 3 days, 3 months, or further, but I'm going to stick with the range methodology for a while. Other than that, let's see if this video posts. Send me your emails if you like. Any questions? I wish you all the best. Send them my way also. And have a good night. We'll see how this works.